Good morning, good afternoon, maybe good evening, everyone. It's a great pleasure to be speaking with you from Tamaki Makaurau, Auckland in New Zealand. I'm a principal based in Auckland for Blackbird, investing in wild hearts right at the very beginning. Before I joined Blackbird, I was a director at Generation, which is a growth equity fund co-founded by Al Gore. It was one of the first to focus on climate investing. And even during my relatively short time there, I saw the space explode. So I'm really excited to be hosting this panel about the current state of climate investing. To do so, I'm joined by 4 of the most influential and thoughtful sustainability investors operating in the space today. We are going to talk about everything from clean tech bubbles to Robert Downey Jr., and we are keen to hear your spiciest questions about everything related to climate investing. But first, let me introduce our amazing panelists. Joining us from Sydney is Lucy Hankin. Lucy is an investor at GROK Ventures, the private investment office of Mike and Annie Cannon-Brookes. Lucy's day job involves investing in and supporting technologies that make tomorrow today. Very intriguing, and I'm keen to hear exactly what that means. What I do know is that this means backing everything from wild technology startups like cell-based meat company Vow, who we heard from earlier in the summit, to the world's largest solar project, SunCable. Before joining GROK in 2018, Lucy was an investor at NAB Ventures. Also joining us from Sydney is Eytan, and I just learned how to say that correctly, Eytan Lenko. In 2009, Eytan founded Outware Mobile, which grew to become Australia's leader in mobile software development, counting companies like Qantas and NAB among its clients. Since Outware was acquired in 2017, Eytan has focused his time on addressing the decarbonisation of Australia's economy. Just a small project. He's done that in a few ways. As chairman at the climate think tank Beyond Zero Emissions, influencing federal policy, and also as co-founder of Infrastructure Access Managers, a fund that invests in unlisted carbon-intensive private infrastructure that has the potential to adapt and decarbonise. Dialing in stateside is Sophie Purdom, who has had a fascinating career at the intersection of climate and investing. So she went from a graduate job at Brown University's endowment fund to 3 years at Bain & Company as a management consultant. Then in her spare time wrote a book about environmental, social and governance, founded an ag tech venture called Cooler Bio, which has gone on to raise more than $65 million, and now writes Climate VC, a weekly newsletter on climate and innovation with more than 20,000 readers. She's working on something new, don't know if she'll tell us a bit about that, while investing in early stage climate technology companies. Last but not least, certainly not least, we have Sierra Peterson joining us from San Francisco. Sierra is a co-founder and managing partner at Voyager, a US-based firm investing in early stage companies that focus on decarbonisation. Prior to becoming an investor, Sierra created and led corporate development teams for financial technology companies responsible for more than 3 billion in sustainability investment. Sierra has worked in market-driven climate protection since 2005, serving with the International Energy Agency and the Obama White House in their Office of Energy and Climate Change. Phew, what a crew. So what I'd like to start by talking about is, reflecting on all of your amazing careers today and the kind of energy and dedication that you have to climate investing. I'm keen to know, this is not our first rodeo when it comes to clean tech. Clean tech, as it used to be called at least, at some point was a dirty term. It was where venture dollars went to die. I learned that between 2006 and 2011, venture funds invested more than $25 billion in clean tech startups, and they lost over half their money. In 2016, an MIT report went so far as to say clean tech offers VCs a dismal risk-return profile, dragged down by companies developing new materials, chemistries, or processes that never achieve scale. So I thought we'd start with Sierra. You've been around the block in this space. Is the clean tech to climate tech transition anything more than just a sneaky rebrand? Are things actually different this time?
Yes, happily so. This is not just marketing. Yeah. So, as someone who's been working in this area for the past 16 years, we've seen it all. We've seen exactly that. Venture dollars go to die in being spent on infrastructure projects and on truly speculative science projects that were never venture scale to begin with. And I think a couple of things have come to pass in the past decade. One, folks learn their lesson and know how to underwrite now for venture scale returns. And there's been a proliferation of capital across the capital stack that not all dollars flowing into climate tech needs to have that venture scale return profile, that you can find folks who are very interested in more stable yield from asset financing, project financing, interesting debt instruments, appearing for investment in climate tagged sustainability projects, among others. So that's one. Sophistication growing in the capital markets themselves and the financial investor perspective. Two, real difference in the foundational enabling technologies that a generation of motivated founders are now building these business models around. I mean, you've had precipitous cost declines in everything from cost of solar, wind, renewable energy generation that just unlock huge tertiary business models around them. CRISPR, advances in biotech, advances in remote sensing and satellite imaging that are enabling new markets in risk analytics for the carbon markets, that are enabling price parity and actually outperformance in alternative protein production. So it's a very different technology landscape than it was even 10 years ago, even 5 years ago. And that's quite exciting. And then the third force is, well, what determines the trajectory of deployment of these technologies? It's corporate demand, consumer demand, and regulatory imperative that have all set in motion the possibility of billion-dollar businesses competing in price and performance alone with their fossil-fueled incumbents. So very different world, happily so.
Absolutely. Is there like a paradigm example of a clean tech 1.0 and a climate tech company that would bring this to life for the audience that's not so familiar maybe with the space?
Yeah, I'll think of something, I'm sure, in the next 15 seconds. But
I think Sophie might
Sophie.
know.
Oh, I clearly make too excited facial movements here. Whoops, I got called on.
No.
Well, I was just thinking about all of the new climate unicorns that have finally been tagged and that we can name. We can name some of these ones. So speaking from most recent anointed green unicorn status, right? The most recent one is Watershed, which is a business that's only been around for 2-ish years or so, and it's a software first business. So Watershed does carbon management, accounting, and decarbonization decision making for high growth tech businesses. I think it's probably safe to say that would not have been a clean tech 1.0 company for a couple of reasons. One, it's software first. Two, it serves technology businesses. I'm sure there's a third reason that our brilliant panel can come to as well, but maybe that's a good one to start with. And there's a whole lot more there, especially in food, which was kind of not included as much in Clean Tech 1.0, that focused more on utilities and energy industry. That's a fun one to run with.
Yeah, I mean, backing up what Sophie's pointing out is that Clean Tech 1.0 really was focused on power generation, the power sector, the grid, and that what we're recognizing is obviously power generation core to enabling truly sustainable atmospheric carbon concentrations, solving that. But this is fundamentally a system. And so we're seeing opportunities for building decarbonized companies, massively valuable decarbonized companies in materials production, in food, in transportation. It is not simply how do we create electrons at lower cost, which is so much of the focus of Clean Tech 1.0. And that's exciting too, because you have a range of entrepreneurs who can bring their talents from across biotech, from across financial system engineering, from, you name it, in the range of applicable experience in building better companies that have everything to do with decarbonizing the entire climate system. So it's a very exciting time to be a founder.
That's a really helpful definition. So the first wave of clean tech, as it was called, was really about decarbonizing energy, which has a lot of associated business model quirks, right? Big infrastructure demands, as you talked about, and ultimately commodity services being provided. Now what we're seeing is perhaps that every sector needs to decarbonize, and there are opportunities for innovative technologies across all of those sectors. So just back to kind of the magnitude of funding that's flowing into climate tech. Sophie, I think you and the Climate VC team did the maths on this recently. So remember the stat that 25 billion was invested between 2006 and 2011. I believe it was something like 40 billion in 2021 alone was invested into climate tech startups. What can we take from that?
You're spot on. Yeah, we track $40 billion just in early stage private funding, just into these 600 or so companies that we've bottoms up categorized as climate technology businesses. And like we've been talking about, these are companies across industries. So we count 7 in particular. Maybe it's helpful to share what some of those are to help lay the framework. So energy, the electrons that power us, everything from generation through to batteries, HVAC, building efficiency. Then of course you've got food and water. So that's everything from your novel, Vow Foods would fall in this category. So your novel alternative protein startups through to agricultural inputs like Hula Bio, for example, a company that I helped get off the ground, that makes sustainable fertilizer. Mobility is a real behemoth here, and we can talk more about the tranche of capital that flows into mobility in particular, EVs, battery tech, etc. An industrial segment, a bit of a catch-all, but you can think of process like heat and fuels, iron and steel. A lot of cement activity falls into this bucket. The 5th one would be consumer. So how we buy and how we invest. That's your fintech kind of ESG next gen platforms, packaging and waste, circular economy startups. The 6th one we call climate or climate intelligence, kind of climate data, risk and analytics, everything from putting novel sensors into space to, keep an eye on what's happening down on Earth, through to we might even categorize Carbon Chain, right? The company that kicked off this presentation in that group. And then carbon, so carbon management, carbon capture, carbon offsets, which has been a particularly hot topic in terms of, I'd say, the press and media and attention, which is excellent, but not necessarily actually reflected in terms of the dollars yet to be deployed there, although the activity rate is increasing. So that's all 7 of them, kind of covers all sorts of industries. And then interesting quick stats. So 40 billion, right, from about 600 deals just in 2021. And relatively speaking, that's compared to the same period in 2020, granted a bit of a funny year, as we all know. That's double the capital invested in the space over that same kind of half-year quarter period, if you compare those to one another. And then within 2021, each subsequent quarter, the funding grew 20%. So like, you can't make charts prettier than that. It's like, not to overuse it, but it truly is literally up and to the right.
Yeah, that is a crazy pace of growth and investment. And it does kind of seem that lately everyone and their mother is raising a climate specific fund, from Bill Gates, who's been at it quite a while, to Robert Downey Jr., who I mentioned earlier. Eytan, how have you, in your position as both a founder, a policy influencer, and an investor, seen the funding landscape evolve over the last couple of years?
Thanks, Phoebe. So I guess, how do I think about funding? Like, we know that the way forward on climate is basically, we need to electrify everything and power it all with renewables, plus dealing with agriculture and food. But that means that, the solution is really about how do we deploy clean tech at scale. So there's really three jobs for funders. There's funding the invention of the technology in the first place, and a lot of that comes down to public research grants, to universities, and VC increasingly playing a role there as well, although we kind of had the issues with Clean Tech 1.0. And then there's the job of starting to deploy and bringing the tech down the cost curve. And in Australia, we've got the ability of organisations like ARENA and the CEFC to get involved in that phase. Increasingly, we're seeing VC get involved. In America. You've got Generate Capital and the Department of Energy Loans program that can play in that space. And then there's also what I think is really interesting, if you think about the whole system, is the flip side of that. How do you drive up costs and risks for the old fossil fuel tech? So that's where investors play a role in areas like divestment, in funding legal challenges, running campaigns, in doing AGM resolutions and things like the getting a board member onto Exxon. So there's lots of different ways other than just funding that investors can get involved in making this happen. And then once the economics are in line, we need to deploy at scale. And that's really where you move to things like infrastructure funds, to companies with deep pockets, to traditional banks, and increasingly to government stimulus. So Beyond Zero Emissions, the think tank that I was a chair of, put out our Million Jobs plan a couple of years ago that really painted a picture of how government stimulus in Australia could roll out clean tech at scale and create millions of jobs. In America, you've got the Build Back Better plan that's been proposed by President Biden to do something similar. And I think where we are right at this moment, there's also this new really exciting category, kind of like a shortcut, which is literally going out and buying or investing in companies that are doing the dirty stuff, but have all the infrastructure in place and a lot of things in place to be able to switch over to clean and actually run more profitably and invest in those. And so that's why I co-founded Infrastructure Access Managers, to invest in carbon intensive assets, which means that you have a seat at the table as a shareholder and you can build business cases and make the case to other shareholders on why decarbonising that asset will make it more profitable and will future-proof it. So an example in our portfolio is the Newcastle coal port, which is the world's biggest coal port. But that port would actually be way more valuable as a container port, and that whole area around it is primed to become a renewable energy industrial precinct and could really be exporting clean energy exports to the world through that port. So, that is a vision that doesn't just happen. Investors need a seat at the table to be able to put that vision across and to bring that capital to making that happen.
That's a great characterization. It's so, not only is every sector on its own decarbonisation journey creating opportunities for all kinds of entrepreneurs, all kinds of problem solving, but the range of strategies that you might deploy as an investor is everything from shorting stocks or trying to influence a proxy battle through to actually investing in that kind of early stage risky technology to unlock decarbonisation. Fascinating. I'd love to hear from Lucy about what it's like, what your experience is working with family offices in the space. So how do motivations of different funders who come to the decarbonisation challenge with different agendas, with different levels of commitment, how does that influence what actually gets funded and how impact is measured as well? We have a question from the audience. I don't know if we can to start looping in an answer there, but there's some curiosity from the audience around whether the types of things that are being invested in now are seeing the same CO2 avoidance payoffs as what might have been funded in sort of Clean Tech 1.0.
Yeah, awesome. Thanks, Phoebe. Yeah, family office is obviously, that sort of represents a pretty broad investment category, effectively where you're investing on behalf of a family or a principal like Mac and Annie. And what that generally means is ultimately you basically have oftentimes a lot more flexibility in terms of what you can deploy because you're managing a single LP, and sort of therefore you're not, say within the case of sort of a VC fund, you're effectively agreeing to a specific mandate, a specific timeline, and very specific risk return profile over the fund's trajectory. Whereas in a family office, you tend to have a bit more flexibility around the type of risk reward you're pursuing and the type of timelines you're pursuing. In our case within GROK, what that means is we have a cross asset allocation strategy across listed equities, early to growth stage startups and VC funds, and infrastructure investing. And that is really useful in what we do, which is sort of more thematic driven investing focused on decarbonisation, given we understand the full value chain and basically how to diversify the cap stack to ensure that we're able to deliver VCs who obviously can deploy a huge amount of capitals into high risk ventures. We can basically enable them to look at opportunities, as Sierra mentioned earlier, with a different lens where you're effectively diversifying the capital stack to basically deliver the sorts of ROIs that VCs typically seek. Family offices are, I think, like a particularly interesting topic in this space because obviously, you know, since the Rockefeller Foundation coined impact investing in 2007, like they've been very active in terms of climate investing. Stylistically can be very varied in terms of their approach, whether perhaps they might be, you know, in philanthropic, impact investing obviously refers to where you're both pursuing sort of positive social or environmental impact as well as financial returns. And family offices can balance those in different ways. And I think it's really important to understand sort of how much they're balancing each in terms of what is really their target returns profile and how much more important is actually the impact side of things. In our case, sort of very aligned in terms of impact from a climate standpoint and returns, in terms of sort of seeking both sort of substantial decarbonisation per dollar deployed at the same time as, like, you know, very market standard risk return sort of profiles particularly within the VC category. And so, yeah, I think today there's a lot more sophistication amongst family offices globally, and you have pretty active family offices operating in different markets. In Australia, I think it's particularly interesting that you get a lot more thematic focused family offices than you necessarily get thematic focused VCs specific to decarbonisation. So investors that are really understanding deeply the value chains within energy, food and transport in decarbonisation. Whereas typically in VCs in Australia, you know, you're constrained in terms of geographic concentration and other things, which means that it's just given the breadth and depth of opportunities here, you're typically investing in a range of themes, not being as focused. And it's particularly relevant in Australia. I was looking at the data overnight, and I think it was roughly around sort of 40 startups in 2021 that were backed by VC. That's out of 700 were actually climate focused startups. That's under 5%. So it's really hard where you're just focused on Australia at this point in time to really focus on climate. And that's why family offices that can invest globally, that can invest across asset classes, that therefore can be more thematically focused in this market, are an interesting source of capital.
Absolutely. How do you see it from a founder perspective? And I'd be keen to hear from others in the group afterwards as well. If you're a founder, how should you think about the choice between, say, a thematic family office investor who deeply knows your space compared with a generalist technology fund that might have other resources but may not be, you know, in the detail around cost down curves of solar cells or whatever it is?
Yeah, and I might for purposes of this question remove sort of the constraint around it being sort of family office, climate focused versus generalist. The reason being, again, family offices tend to have different risk return profiles and tolerances, and you know, in some instances where perhaps they're more impact focused, perhaps they're less driven by like motivating founders to say like hit this milestone, prove this, validate this piece of the tech and the commercialization strategy, and therefore, you know, we'll continue backing it. They might come at it with a more philanthropic lens, which can in some instances have, impacts on how founders sort of pursue like how ambitious they are from the commercial point of view. So it just depends on the type of family office you're dealing with, but specifically related to sort of more thematic versus generalist investors. I would say one of the biggest value adds of having a more thematic focused investor at the table is generally they'll have stronger networks and expertise within a specific category, which can be hugely value add, firstly, in assessing your tech and asking the right questions and truly understanding sort of the type of business models and commercialization strategies that are plausible, identifying the right sort of people, whether it's customers or team members, to meet at the right time. Is obviously a key thing as well. So I think it really comes in terms of like deeply understanding the sector and the opportunity. I think it's obviously hugely beneficial having someone who really specializes in that area as opposed to sometimes a generalist. Another aspect of that is just generally when you've been in sort of climate for investing in climate consistently for a long period of time, it shows a level of conviction. It's not just like, oh, this is a hot sector, now I'm going to go invest and deploy capital. It's actually, I'm highly convicted and I understand the space. I think one thing that's interesting often when you see more like, and this is a very general comment and doesn't very general comment, but something you occasionally see where the thematic becomes very sexy, is that the valuations proposed by generalist investors can get really out of whack with actually what is commercially achievable within the specific vertical and model that a startup is pursuing. I mean, we've seen it within sort of the clean tech space in the US in terms of us getting well ahead of ourselves, discounting backwards, 5 years revenue sort of things in terms of valuation. So I think thematic focused investors can also understand what is truly achievable from a business model and commercialization perspective in some instances. And maybe in some instances also they might be too constrained by what they've seen in the past. So maybe you do sometimes need a bit more of that imagination from the generalist investors, given how fast the industry is evolving. So there's two sides of the coin. Both are really interesting and compelling, but definitely worthwhile having both on your cap table if possible.
Yeah, Sierra, I'd be interested in your thoughts as someone who's just successfully raised a climate-specific fund.
Yeah, thank you. We completely concur with Lucy's perspective. What we're finding is that founders are really excited to talk with us. We just bring better part of 28 years of domain expertise in climate to our conversations with founders. We bring the deep credibility of people who have been doing this for a long time, who've launched very successful businesses. My co-founder at Voyager was, the companies that she was responsible for founding and leading from an early stage in climate tech alone are worth $1.7 billion today in transportation and alternative protein. And I helped to build some companies in financing for energy efficiency and solar. And that's just valuable experience that founders want to leverage in enabling their businesses to get where they're going to go faster. And, as a former policymaker, I know how to navigate those markets, which, frequently some folks who are coming out of more traditional tech backgrounds are not accustomed to selling into regulated markets and having to think about, if you're selling a power systems optimization technology, you got to deal with the regulators. Like it's a new type of dance that have to know how to do, and it can really slow you down if you're not accustomed to having to think through what are the sort of entry points in conversations you need to have. So what we at Voyager, our core product out of Fund 1 is in leading and co-leading, and we specifically size the fund to be able to co-lead with very prolific, accomplished generalist tech investors who look to us. In fact, many of the GPs are LPs with us in Voyager, so we serve effectively as their scout fund in climate tech. And to be able to say, all right, you don't have to choose your generalist tech top tier or your terrific climate tech expert fund. You can choose both, and we can help out on deep tech climate questions. If you choose, top tier generalist enterprise SaaS fund, they know how to do this model better than anybody else out there. So choose both. And that's what we're finding, the most competitive rounds that we are seeing and certainly participating in and, co-leading and leading include that strong syndicate of experiences. There's a rush of generalist tech investor interest in climate tech, but it also looks for validation from firms like Voyager, who bring a lot of experience in the ups and the downs, the years of performance of these technologies and these markets to identifying and validating the most promising teams.
Mm.
Yeah, I might just do a shout out to, I guess, startups considering well-connected, passionate angel investors as well. I know a lot. I do a lot for the climate tech companies I'm invested in, and I know there's a whole network of people out there that like really push their networks really hard and so passionate about the space. They'll do anything to kind of help these companies. So just making sure that you're also thinking about bringing those people onto your cap table, because they can add often just as much as a fund that's kind of focused across all of their portfolio, and maybe not share the same level of personal passion as an individual might be to your mission. So think about getting some of those people on board. It's been super helpful, I think, for the climate tech companies I've been involved with. Yeah,
and we have such a strong angel network here in Australia and New Zealand, particularly in climate, actually. It's interesting and definitely worth mentioning. Sorry, Sophie, cut you off.
Not at all. I was going to say, it goes to show the importance of these new funds needing to be able to define their product. It's no longer good enough to just be there, and be accepting climate as a approach. You have to have a particular niche or credibility or set of value-added products or services, right, that you can offer. When there's 64, or at least we counted, and I'm happy to share that. I'll drop in the chat later, like how we count that, but we counted 64 new funds that were announced that are climate tech funds just in 2021. Some of those are mega, some of those are, in the like 50 to 125 kind of range. And particularly what I'm excited for is a lot of those are from existing names. So existing firms that are launching new climate funds, think USV, for example. Now we're seeing entirely net new firms with new GPs that are climate first coming into the space, and expertise matters.
Yeah, we've got a question in the chat there, which is an interesting one. So are there some of those funds that you're seeing perhaps be born or be founded alongside existing investment teams that are actually willing to trade returns to increase their impact on decarbonisation and kind of measure their success around CO2 avoidance or emissions avoidance?
Sorry,
Lucy, go ahead.
No, you go. Definitely, I'll turn it off.
We've not seen so many funds willing to trade. I think it's, instead what many of the climate tech funds who have come to market recognize is that emissions avoidance and carbon removal are intrinsically good business, if built around a business model that's well executed. And so they're, instead for Voyager, we evaluate the unit economics to be obviously capable of supporting $1 billion business model and succeeding absent long-term subsidy relative to a fossil fueled incumbent, and also that the carbon impact is core to that revenue stream. So it's never for Voyager a choice of climate impact or profitability and overall venture scale return. And we've, just by the numbers, we looked at now 350 plus companies invested in 5. So, and the majority of the companies we've looked at have had that intrinsically linked profit and carbon benefit. So it's not a choice in today's funding environment.
I'm not sure it works to make that choice in a lot of instances, in terms you want these companies. I guess it depends on the circumstances. I have obviously less experience in impact type investing, but in terms of like VC investing, where I spend the majority of my time, or infrastructure, ultimately, generating a return profile commensurate with the risk that other investors, commercial investors, have an appetite for, is fundamental to achieving scale, right? In terms of ensuring that sort of $1 billion are funded into these opportunities, such that they can grow and be viable on a standalone basis, which is absolutely key to their success. They ultimately need to sort of deliver that sort of commensurate risk return profile. And as Sierra said, there are plenty of opportunities that we believe can do that are still at very early stages, and so on. Yeah.
I think a better way to think about this, rather than thinking about reducing return, is to recognize that this is kind of quite a pretty unique investment environment. I mean, like, we're kind of in a war, like, you know, we're trying to race against time on climate change, and we've got all these incumbent vested interests that are also working super hard to stop these companies from being successful through their, you know, lobbying and incredible government contacts. And we've seen that play out in Australia, you know, very often. So, you know, to me, I think investors need to try to get more comfortable with advocacy as well. Like, so they're investing in this sector, but they also need to get comfortable advocating for the success of the sector and for government policy and regulation to come in behind it, so that the sector has tailwinds, which will ultimately improve everyone's returns. So, you know, when Mike and Annie Cannon-Brookes came out recently with their climate pledge, it was $1 billion to climate investing and $500 million to advocacy, because there was that recognition there that advocacy, you know, you can't just think of it as philanthropy. It's almost like business development. You're like investing in the tailwinds that government regulation is going to provide to your portfolio companies. So I haven't really seen that yet at scale. I've had a lot of conversations about it, and I haven't seen mainstream funds take that on. But I think, you know, they should be thinking about putting a certain percentage of a fund into advocacy, because ultimately that's going to improve the returns of the fund.
Yeah, we had a question in the chat around whether maybe more generalist funds take into account a carbon price, or how that landscape might change when they make non-climate investments. And perhaps as the generalist tech investor on the call, I can comment that it's certainly something we consider when we invest. So actually just last week, we published details of our impact approach at Blackbird, which is hot off the press. And something we certainly ask ourselves at the point of investment is, you know, does this company have the potential to become generational, meaning that it's sort of around in 10, 20 years and thriving in the landscape as it exists at that time? And so, of course, we need to think about which sectors, which customer bases are going to be in good health or not in good health, and what the policy regulatory landscape might be at that time. So I think this is increasingly on the minds of all investors. One other question in the chat, which is an interesting one, particularly for anyone who's fundraised in the past. Sorry, did you want to say something, Sierra?
Yeah, I did. I mean, to the point of really quantifying climate risk and carbon risk, this is actually an area of the financial system where the big dinosaur firms actually have been leading the way in some ways, you know, where you have this recognition of climate risk as financial risk from the world's largest asset managers, and the financial system in Europe in particular, you know, the United States coming around in some ways, is underwriting the risk of fossil fuel assets and infrastructure being potentially stranded assets with particular prices that may or may not come into play in the US, but are certainly, we're seeing the pricing signals of the European Union emissions trading scheme, 100 euros a ton. That is meaningful for determining long-lived infrastructure investment. And those sorts of pricing signals, you know, it's not a question of, is this real or not? It is, what type of risk does this represent for us as a financial institution? This is just another source of risk that has been priced in. Whether that price is accurate, who knows? It's a question of, you know, opinion, but it is a meaningful signal that is being priced into at the very top of the overall underwriting of assets, of business models, of portfolios from the, you know, the largest financial system actors in the world. So it's interesting to see, I wouldn't say leadership, but certainly a recognition of climate risk as financial risk, and that trickling through underwriting, and certainly in the proliferation of carbon accounting firms selling primarily now to large financial asset managers.
One question we had in the chat was around biodiversity as a thematic. Have there been any sort of venture backable solutions on the biodiversity front that anyone's come across? It's a tricky one. Natural climate solutions, perhaps?
Yeah, it's an interesting one, because when you think about, you know, what makes a market, it's the fact of having, you know, an input currency. In this case, the coin of the realm is a ton of carbon dioxide equivalent, and it's the ultimate global commodity. It's everywhere around us, and so it really doesn't matter necessarily where you pull it out of the air or where you stop its pollution into the air. biodiversity, very much place-based, difficult to measure. And there's, the best proxy that we see is in habitat conservation right now. We've seen a few business models, from particularly a market-driven approach. We've seen a few business models that have been set up with distributed sensors to try and capture, say, different bird calls, the sounds of different animals moving through a forest. But because it is difficult to scale that sensing, you can't necessarily apply the same satellite imaging that you can for detecting carbon sequestered in biomass for understanding, well, how many jaguars per hectare are there? It's tough. So we haven't seen, at least for Voyager, we've been looking, but we have not seen that many compelling business models yet set up with a market-driven approach to biodiversity protection.
Plus one on that, I think the integration will probably be most likely as a co-benefit, aka higher willingness to pay for carbon offsets or carbon removals. Actually, I got, to bring a prop into it, I got this little guy when I was in Kenya, helping pull together a pilot program for a company called Cloud Agronomics that uses satellite sensors for measuring the carbon content in agricultural soils. There's no reason that we can't apply that to the Masai Mara and other places like that, where it turns out richer soil health and carbon health is directly correlatable to more of these guys, little elephants, right, floating around, which then means more livelihood, etc. But it's still very fuzzy. But asterisks on all of that. That's the kind of like ideal state. I think what we're seeing right now with more of the like Web3 ties into the carbon markets is that you're losing some of those co-benefits because you tend to write about those in paragraph type of form. I just told you a story about this guy. How do you turn that into, a number that plugs into an algorithm? So we'll see where that goes.
And how do you value something that is ultimately more subjective than a ton of carbon? All right, we are coming up on time, but I wanted to just go through a quick fire round to hear your perspectives on a couple of questions. You each get to meet hundreds of companies over the years working in the space. I'm keen to know, what is the wildest climate tech idea that you've been pitched? And I'd love to go to Lucy first.
It's funny because so much of our job is figuring out what's not crazy. Like, what parts of this do I need for it to believe for it to be successful, and is the market big enough on the other side? I might actually just, and on that point, I would say like something like a vow, where basically they're recreating meat in a lab, and at the same time saying, look, we don't believe that sort of meat products in the future will look like what they do today. We don't need to be constrained by analog products, and therefore like solving for a completely new paradigm in meat products like that is in itself, I think, having such a differentiated perspective, perhaps in an area that's a number of companies are trying to solve products in.
Sierra.
Yeah, I completely concur. I mean, some of them, the best pitches are ones where at first glance you're like, this is total sci-fi. And then you realize, but this is possible. And this has only become possible in the last 24 months. And this is the founding team that is really capable of, one, seeing the future and then building in that direction. I mean, we've led the pre-seed of a company recently. It was companies in stealth, but I was like, this is totally bananas. And then I realized, but if this works, this can completely revolutionize how power is delivered across a grid. Like, okay, yeah. And you know what? This founder could actually pull it off. So the ones that I think that are really, really ambitious and that have the technical capability to actually make good on that vision, that's the kind of stuff that we like to see.
On the flip side, what are you not seeing founders work on? Is there an area of climate tech that's underexplored that you wish more people were working in? Sophie.
Yeah, I think I anticipate that I'm watching the kind of like trends where the capital is going. I think we'll see a lot more in oceans over the next even kind of like quarter to 6 months. That could be ocean CDR, ocean, acidification, etc. Everything from like seeding the ocean to more stuff on seaweed. Granted, there's papers coming out literally like this afternoon saying, hey, watch out, that stuff is actually still really expensive and hard to verify and measure. But I anticipate that we'll shift more in that direction as CDR continues to be hot and as people are looking for more land and space essentially to go after that.
Unpack CDR for us.
Thank you. A TLA, 3-letter acronym that should be spelled out. CDR, carbon dioxide removal. So falls in that camp of sucking stuff out of the atmosphere or carbon out of the ocean, frankly, and locking it away. Often correlated with CCUS, carbon capture, utilization, and storage. It's basically sequestration. So where an offset is in large part kind of avoided emission of you're being paid in some way to not emit that net new carbon. You're saying, hey, this carbon's already been emitted. Let's take it out and negate it and store it for an uncertain amount of period of time, but hopefully permanently. Yeah, and then I'll just drop a couple. The past couple of founders that we've interviewed have been doing moonshot, totally breakout technologies. One's Commonwealth Fusion Systems. Fusion, right? And
very
then
hot right
another
now.
one,
Or
very hot
cool.
right now. Totally, or just go raise a whole fund focused on it. Wink, wink. And then also one called Quaze, which is, we kind of made a teasing joke of, it's almost like you're taking fusion and you're using it for geothermal, but using tiny little, really concentrated waves to take existing, usually oil and gas or mining sites, and go further into the Earth's mantle so that you can create geothermal, a very clean, renewable energy source anywhere, and most importantly, convert those existing sites that are dirty energy factories. You keep your same jobs, you keep your same people doing their same, keeping their 401k, and you convert it into a clean energy site. So really novel forms of a non-disruptive clean energy transition.
All right, one-word answers from each of you. Which area of climate tech is overhyped? Eytan.
Anything that competes with lithium batteries.
Sierra.
Yeah, I think the path dependence on lithium is pretty well documented in many applications.
Sophie.
Electric vehicle original equipment manufacturers, EV OEMs.
Lucy.
Might need more than one word, but generally speaking, you know, a lot of the time we're seeing basically new technology solving very unique problems in industries which require significant amounts of vertical integration. And oftentimes you see investors coming at it trying to reduce risk by taking the pick and shovel approach, where ultimately the industry is not ready to modularize. And so I think coming at industries generally with conservatism and trying to reduce risk by finding a unique play in the value chain, say whether it's like an incremental software play or it's too early to pick the pick and shovel, I think is a pet peeve of mine. But
Love that. This has been so much fun. Thank you all very much for your time. I'm